Hey everybody, welcome. My name is Preston Zeller. I am a realtor in Southwest Washington, Vancouver, with Cascade Home Sales, and I'm joined by my friend Curtis here, who's going to give us a walkthrough of the new HomeReady program from FannieMae and share a bit of his insights as to why it's really a good program. Curtis is with Landmark Professional, the mortgage company. And Curtis, why don't you give us a just brief rundown of, the 60-second version, I guess, of yourself and, and Landmark, and I'll give you an opportunity to go through that again later towards the end of our chat here.
Sure. Well, I guess maybe a good place to start is I've been a loan officer for a little over 10 years, so I've certainly seen some ups and downs. Landmark Professional Mortgage is a locally owned company that's been in the area for 34 years. We're based out of Salem, and I opened this branch for them in June of 2012, and it's been a fantastic 3.5 years as we help our clients in Clark County and Southwest Washington. That's my area for the company, and it's been a great run, and I expect even better things for 2016.
Awesome. That's good to hear. Well, I know we had sat down, I think, a couple weeks ago and just over coffee, and we're talking about different things in the industry right now and what to expect in 2016. And that's where you brought up the HomeReady program. And I know it had come out in, I believe, late last year, and you just knew a ton about it. You wrote a fantastic post on my blog that I'll share with people here, and they can kind of see what that looks like. And yeah, basically you just laid it out really well, but I thought it would be even better to, really dive into maybe, for people who don't want to necessarily read through it, or they want your firsthand, viewpoint of how great this program is, and just some more of the details that we might not get from just simply reading it. So I'm going to go a little bit backwards of how the article starts, because I know you have a great writing style, being a writer. And why don't you just give us the elevator pitch, the brief rundown of what the HomeReady program is all about?
Well, really, it's not exclusive to just first-time home buyers, but it's probably most beneficial to them for a couple of different reasons. For starters, it does allow for only a 3% down payment, so it's even lower than FHA, who needs 3.5%. And one of the primary benefits, one of the best reasons that this will compete directly with FHA is the mortgage insurance. FHA used to be a kind of the no-brainer go-to option for anybody that was looking to buy a home and didn't have a large down payment, because they're pretty forgiving on just about everything, including blemishes on the credit report. However, a couple years ago, in fact it was June of 2013, FHA changed their mortgage insurance to now last for the entire life of the loan. So 30 years of mortgage insurance, that's kind of a bummer. And even if you 10% or greater on the down payment, it still lasts for a minimum of 11 years. So either you pay for 30 years or you do 10% or greater down, in which case, why are we doing FHA anyways? And then you still get stuck with it for 11 years. Not the case on the HomeReady program. This one is just a regular conventional loan. So the mortgage insurance can and will go away once you have achieved 20% equity. So the primary bonus here, in addition to the lower down payment, is you don't get stuck paying mortgage insurance for longer than the bare minimum necessary. So no one wants to pay that. The mortgage insurance protects the bank, not you. So if we can get rid of that as fast as possible and lower your payment by, sometimes even a couple $100s a month, that's kind of a big deal. And we try to set it up in such a way where we don't know what the future holds. I don't want to set the stage for you have to refinance X number of years later to get rid of it. What if you have a loan that you could, in theory, keep for the next 30 years because you know the mortgage insurance will go away anyhow? That's the best part of this loan.
Excellent. Thanks for that rundown. Well, I'm going to dig a little more into the article here. One of the topics we kind of had was how it beats it. Did you get into, I guess, Let's do properties you can buy with HomeReady, because there can oftentimes be limitations, right, on what type of property you actually can finance. So let's dig into a little bit of what kind of properties you can buy with HomeReady.
That's a good point, Preston. Really, this one is going to be property by property on kind of a case-by-case basis. And the reason for that is that in order for a buyer to be eligible, it depends on what census tract that Fannie Mae has placed that home in. It's not just as basic as a county-by-county thing like most loan programs are. This one is going to be individual census tracts which are significantly smaller. There's 105 distinct census tracts within Clark County alone. And out of those 105, 70 of them require that if the buyer earns greater than 80% of the area median income for that census tract, unfortunately you make too much. You cannot use this program in that census tract. There's one out of the 105 census tracts that allows for you can earn up to 100% of the area median income. But the good news is there are over 30 that allow for no income cap. And that's really where I think that this program is going to be most useful for the general public. Is it doesn't matter if you make $300,000 a year or if you just barely squeak by with the bare minimum. If you're buying in a census tract with no income limit, it's open to everyone. So that's just something to be mindful of when you're shopping for a home. You want to know where your gross income is, and as you look at a particular home, if it happens to be in the census tract that says that you're not eligible if you make more than 80% of the AMI for that census tract, well, let's know that in advance so that there's no nasty surprises.
Cool, that's really good to know. And how does shifting to how the down payments work? Is there any difference between FHA and HomeReady in terms of where those funds can come from, or are they pretty much the same? What's the deal there?
They're very similar. For starters, again, HomeReady is slightly lower at 3%, whereas FHA needs 3.5%. But neither one of them require any borrower contribution. What that means in plain English is if you can get all of your money in a gift from a family member, you're not required to put in X percentage of it from your own funds. So in that respect, they are actually very similar, where it's pretty easy as long as we can paper trail where the money came from and basically prove that it's not a loan. Either one is fine with that. It's kind of level playing field.
Okay, that's good to know. And then let's get into one of the probably really appealing aspects of the HomeReady program, which is the job loss protection, which that's a fear for a lot of people, right? Is just the what if, what if I lose my job? And, unfortunately, a lot of people don't necessarily have 6 months of savings. So, how does HomeReady, I guess, help with that, if that is to occur?
You're right. That's a pretty fantastic feature of the program. Buying a home, especially your first home, is a huge financial step forward. But it can also be intimidating because you're signing up for a large payment sometimes for 30 years. It's not something to take lightly. In fact, I remember when I bought my first home, which was the very, very beginning of 2010. Okay, I was looking for my home during late 2009, and for any of you who read the news back then, that was kind of a scary time for the mortgage industry. I mean, my competitors were going out of business left and right, and even though I personally was enjoying great success and it was very solid, you always have to wonder, yeah, but just because I'm doing well, do I necessarily know if my company is doing well? It's scary, and there's always that miscellaneous fear of, what if I sign on the contract and shortly thereafter financial calamity strikes? What do I do? Well, that's exactly what this job loss protection insurance is for. Now, hearing the word insurance, you might automatically sour to that, but this is actually one of the few kinds of insurance that you do like because you don't have to pay for it. It's not that it's free, Radian Mortgage Insurance will pay for it for you on your behalf. So here's how it works, is at any point within the first 2 years following the close date, it's in effect. So if you fund your loan, if you close it at the very end of March, you're good through the end of March 2 years later. And what it's specifically designed to do is take that fear and uncertainty off the table, because they'll help you make the payment up to 6 times if you lose your job or have a dramatic reduction in your income. Now, it is capped at $1,500 per month, $1,500 per month, and it's also going to be limited to what percentage or portion of the qualifying income was lost. For example, for easy math, let's say that the mortgage payment is exactly $1,500, and the co-borrower loses her job, and she was exactly 50% of the income used to qualify for that loan originally. This job loss protection would look at that and say, okay, you lost 50% of the qualifying income for when you signed up for this loan, therefore we will help pay 50% of the mortgage payment. In this example with easy math, they would pay $750 out of that $1,500 payment, and they'll do that up to 6 times until the family gets back on their feet and gets back to work. It does not need to be consecutive payments, so it's not like use it while you can and go out of your way to not get back to work because you're going to lose the benefits here. It can be a sporadic thing, as long as it's within the first 2 years, and as long as the portion that they're contributing is not exceeding 1,500. And also the grand total for the 6 payments may not exceed 9,000, which is the 1,500 cap times the 6 payments.
No, that's fantastic, and that was a great breakdown. And that, something like that is very reassuring for people, especially, we hear so much today about, we're fully recovered and economically and those types of things. But there's, on ground level, there's still a lot of uneasiness with people, and no matter how long you've had a job, really, you're kind of like, okay, you just got to be on the lookout for yourself and your family, and what could happen, like you were saying earlier. So that kind of safety net, so to speak, is just a really great feature of that. Next thing I want to jump into, and this will kind of bring us towards the home stretch of this overlook at the HomeReady program from FannieMae, is the eligibility. I know you talked about the census tract. Is there anything else that you would like to add to that? And I know that you'd mentioned too that something about since December 16th of last year in the bond market and interest rates, and how that might tie into what the census tract and eligibility.
Sure. Well, that's a good question, because while I mentioned that this is not for first-time homebuyers specifically, the only stipulation in that category is that you may not own another home at the time of closing. So, for example, if someone is selling their current home and planning on using the proceeds to buy their next home, you can do that still. You can still use this program. You just need the sale of your current home to close 1 day before the closing for your new home, so that technically when we are funding the loan and recording it with the county, you do not own any other homes currently, and that's all that's required to satisfy that detail. So it's also for primary residents only. This is meant to promote home ownership. It's not meant to help build an investor's portfolio, so you can't use this to buy an investment property, and it's not for second homes. I mean, certainly it's a good thing when possible to own a beach house, but that's not what this program is for. So it is primary residence only, and you just can't own any other real estate at the exact time of closing. If you get rid of it the day before, close enough, that works. As far as eligibility, that's pretty much it, is what I just discussed, as well as making sure that you don't earn too much income for the particular census tract that you're looking in. I should also note that as far as the income for that individual census tract, that's just for qualifying borrowers. Say, for example, the wife just barely earns below the cap for a house they want to buy. Okay, well, if the co-borrower, the husband's not on the loan, we don't have to hold that household income against them. It's just for whoever's on the loan. As long as you don't earn too much by yourself, that's okay. We don't have to count income from someone that's not qualifying with you. So, there is a little bit of flexibility in that regard. Compare that with USDA, where they look at all household income, regardless of whether that person's on the loan. In fact, they go so far as to say with a USDA loan, you know what, anybody who's 18 years or older in the home, we have to count that income, which I've always thought was a little bit ridiculous. What if you have a kid that just graduated from high school and is working at Taco Bell? Technically, you're supposed to count that income in the household income, and it could be enough to say, sorry, that household earns too much money. Well, that's a little bit silly because the kid is probably not going to be on that mortgage and probably isn't going to live there that much longer anyways. That's not the case with HomeReady. It's if the household earns too much income to use this program in that particular census tract, that's okay. We can remove borrowers as needed. In this case, let's remove, the one of the two spouses, and they can still both be on title and they both own the house. We just get to work that paperwork loophole to make it to where the income isn't too much, as long as, of course, as they still qualify by themselves.
Cool. Yeah, that's great information. I just thought I'd pull up the income kind of map here that we have linked from the post that you wrote. Let me see if I can get, yeah, there we go. And pretty neat how it'll ask for an address or another kind of longer number, but the FIPS number here. Do you know where to get this FIPS number? Is that an area number, or is that something you guys give?
It's something that's available on the HomeReady website under the income eligibility section, which is the same area that you went to pull up this map. There's an Excel spreadsheet that lists out all of the various FIPS numbers per census tract. So, really what I recommend for someone that's considering using this program is just type in an address for a listing in an area that you're interested in, and it'll pull up a map like this. It will show what the area median income is for that census tract. It'll show you the borders of that census tract. It'll tell you whether there is any kind of income limit. In this case, on the screen we're looking at, there's no income limit. So you know that if you're buying in that neighborhood, you can do whatever you want. Now this one that's on the screen says 80% of AMI. So that means, and they calculate it for you. If the qualifying borrowers earn greater than $120 per year, you can't use this program in that particular census tract. So if it's a family that doesn't earn more than $59,000, hey, this is a fantastic program to help get you into the home with as little as money out of pocket as possible on the down payment. Also, it has reduced mortgage insurance compared to a normal conventional loan. And we haven't even touched on the fact yet that it actually has reduced closing costs, because the whole point is to make it easier for people to buy homes, not to line the bank's pocket. So there's quite a few different monetary benefits to save money immediately with this program.
Yeah, that's great, and a good point to bring up. I think anyone looking in their area, whether it's where we're located or beyond, this is a great tool to have. And this isn't even something you necessarily have on the if you go to like USDA or whatnot. It's just a little harder to figure out this kind of information. And like what you said, they count everyone in the house, which doesn't really make a lot of sense to someone borrowing or applying for it, but is what it is. So
right.
Well,
and
yeah, go ahead.
It's fairly user friendly on the website. I mean, I'm certainly happy to look into property eligibility and tell anyone what the income limit, if any, is for a particular census tract, but it's actually pretty basic. I mean, you click on the income eligibility link and you type in an address, and it pulls up that blue shaded area of the map and just tells you exactly what the income limit, if any, is for the area. So it's Don't be daunted by a database on a government website. It's actually really, really easy. And also, I wanted to touch on the example that I included in my post, which
Mm-hmm.
is a lot of times at first glance, a home buyer may look at this and think to themselves, oh well, that census tract says that we can't make more than 59,000, and we do. I guess I can't use this program. That's not true. Maybe it's true for that particular census tract, but if you look at the map, a lot of times these census tracts are, they're small. They're measured in, square blocks. And that's why there's 105 of them in Clark County alone. So just because one census tract is limited to 80% of the area median income doesn't mean they all are. In fact, I believe it was 30 something, I can't remember off the top of my head, that have no income limit. We were looking at one in my office recently, where on just the north side of McGillivray, sorry, this one is 80% of AMI limit, but on the south side of McGillivray, there was no income limit. So when that borrower was going to look at homes that weekend, they knew going in, if you want to put in an offer on the home that's north of McGillivray, okay, you can't use this program. If you're interested in the one south of it, you can. And that's why I meant, it's a property by property thing. And even more specifically, my office is currently working on a home purchase for a starting player on an NFL team right now. And not even counting bonuses and all of the other forms of income, just their base pay is $40,000 per month. That guy is able to use this program in a census tract that has no income limit. So don't disqualify yourself because you think you make too much money. All that means is you probably need to be considering a census tract that has no income limit. If he can use it, you can too.
Excellent. That's good to know. Well, let's wrap it up here, and any kind of other information you'd like to say about Landmark and yourself, and how people can get a hold of you. Feel free to talk about that real quick, and I'll put some of your info up on the screen for people. So.
Sure. Well, in general, I'd like to just say that we try to be, understanding and somewhat casual about the application process. For anyone that's watching this, you haven't met me, you don't know me. I get that. So, if you want the short answers to your questions on, where are rates, how much would I have to bring to closing, what's my best loan option, typically how I answer those questions is I just take some handwritten notes. And if you tell me your credit's perfect and that you have a $60,000 salary and the only debt you have is a car payment for $250 a month, that's fine. I can work some general numbers off of my handwritten notes and give you the short answers you're looking for. I try to approach it in such a way as, what if I was on the other end of that phone call? I want to know approximately what's available, and I don't want to have to give you my life story, my social security number, and my tax returns to get the answers. So that's how we typically operate, is try to give you the info you're looking for so you can decide, does that sound good? Do I want to take a closer look into this? As far as Landmark Professional Mortgage in general, our whole philosophy or stance is we want to look at every loan option for you so that we can find you the one that saves you the most and costs you the least. So just because we have this fantastic program doesn't mean that we're going to be tunnel vision on just this one program, take it or leave it. What I like to do is we'll price out an FHA loan, a HomeReady loan, and a regular conventional loan, and then we can look at all three of them side by side and compare the interest rate and payments, the down payment requirements, closing costs, etc. And then that way you have the info as the consumer that you need in order to decide which one is going to align most closely with what you were looking for. And as I mentioned at the beginning, whenever possible, we try to set the stage for, if you need to keep this loan for 30 years, it's comfortable to do so. The last thing I want is for any of my clients to get stuck with 30 years of mortgage insurance, knowing full well that that means that they're going to have to pay closing costs a second time at some point in the future to refinance into likely a higher interest rate to get rid of the mortgage insurance. What if we can just do that right now and put you in a situation where it's going to go away? And that way, if the market shifts and rates go up, which unfortunately is probably more likely than not, that's okay. You have a loan that you can keep forever, and you don't have to spend money twice to fix a problem that we should be avoiding today.
Cool, fantastic. Well, thanks for sharing that. Um, Guys, I just, I put the website up on the page, and why don't you just say your phone number real quick if anyone is sitting there with their phone ready right now and they're like, I got to call them.
Sure. The office number is 360-841-2099. However, I am always available on my cell phone as well, and that number is 360-521-1910. Well, I typically work, 8 to 6. I am also available after business hours and over the weekend. So if it's just not possible to call during the day, that's okay. Feel welcome to call me on my cell phone at any time, and I'm happy to help answer questions. And if nothing else, just give you a general idea of what your options are. I never give a no. Sometimes I give a not yet if we don't qualify. But as a value-added service, I'll also help you figure out what needs to change, what progress do we need to make, what's our plan to get you to the point where, maybe 3 to 6 months from now we do qualify. So I'll help you get there even if it's not ready today.
Great, fantastic. And if you want to be in the know on more kind of interviews like this and just get tips direct to your email, at the bottom of the article here, you can sign up for that. But Curtis, wanted to thank you very much for just writing this fantastic article and sharing your knowledge with us about the HomeReady program. And I hope a lot of people find it useful, and look forward to putting out more content like this with you.
You are very welcome. I appreciate the opportunity to share. It's a brand new program from late December, so I want to let as many people know about it as possible and see if maybe it's a good fit for them.
Cool. That sounds good. Well, I hope everyone has a great rest of their day, and any questions, feel free to call Curtis, or you can, reach out to me on my website as well. So thanks everyone, and we'll see you soon.
Thank you.